Let's welcome in a special guest now. Kashyap Pujara, Executive Director, Head of Research, Axis Capital, is now with us. Kashyap, thanks so much for taking out time for us. What's the way forward for equities this year, given the slowdown in the economy, global weakness, overall sentiment not looking that great?
So I think overall, if I look at markets where they are, which are close to 17, 18 times 1 year forward, slightly above mean, as far as valuations are concerned, and if I see the current demand slowdown, which is very much still well entrenched, I think in the interim, economy is going to take a U-shaped form of recovery. So we are not going to quickly recover in the next quarter or so. So we might be in a U-shaped recovery format, given that the fiscal firepower by the government has been spent in the form of a corporate tax rate cut, which is not going to give us an immediate demand boost. But having said that, with corporates actually saving on those tax rates, eventually the investments will scale up, and potentially I would say that over a 1 to 2 year horizon, the GDP growth will surely be higher. So progressively you will start seeing print GDP to be better quarter by quarter, and we'll see that in Q4 the GDP will be far higher than where we are now, and likewise for the year ahead. So in my view, it will take a U-shaped form, and we will see economies gradually coming back. And from that perspective, I think markets will, which are to an extent buoyant at the current point, are sensing that there is going to be a recovery up ahead, and people are taking cognizance of that and making investments based on a viewpoint of 1 to 3 years.
Private versus public banks, what are the trends you're observing? What do you expect in terms of market share changes over the next year?
So I think the key trends in the banking space, the way we see it, is that dominance is going to play out. The dominance of private sector banks or the large public sector banks is definitely a very strong competitive advantage, which is not going to be displaced anytime soon, given the issues NBFC space as such is facing. And a large amount of private public sector banks even would require capital. They will be getting into provisioning mode, or to that extent integration mode. So there is going to be a natural market share shift from the public to the private banks, and I think the large banks in the private space and the largest PSU bank in the country will only get bigger over time, and size advantage will just get magnified. I think one key trend that we are seeing, apart from dominance of these large names, is also convergence. So historically we've seen banks having retail oriented banks being separate than corporate lending oriented banks, and we are now seeing increasingly where the large corporate lenders our business models are becoming very similar to the large retail-led lender. And to that extent, I think convergence is only going to get magnified. And in fact, if one were to look at incremental lending of the banks, most of the banks have converged business model already. So it is just a question of time before the valuations converge. So you might have large retail oriented lending bank having a much higher valuation premium, and that valuation premium, in my view or in our view, will shrink over time, and some of the large corporate lenders will converge. So these are two key trends that we see: dominance and convergence.
What are some of the factors that make mid-cap looks more attractive in the current market scenario?
What we are seeing as a trend is that not only have mid-cap valuations got extremely supportive, we've also seen participation of institutions on mid-caps go down by 600 bips over the last 5 to 7 years. And as the GDP growth revives, which we said that it's going to be a U-shaped recovery, mid-caps will actually get the advantage, because mid-caps do well when GDP growth surprises. And as we start seeing GDP recovery going forward, and as the recovery gets a bit broad-based, we will definitely see mid-cap valuations and mid-caps outperforming the large caps. That's basically our call over the next 2 to 3 years. And we have actually published a report which actually highlights which mid caps which we believe in will likely double in the next 4 years. Now, having said that, as far as the segments of the market are concerned, I think sectorally, as we said, that we do prefer, banks, which especially the prominent names, given the dominance that's playing out there. And in other segments, I would say that it's interesting to see, companies in the pharma space at the current point in time, because you are seeing a situation where many good companies, good businesses are basically going through a bad patch. And over a 3 to 4 year period, there is an opportunity to be made there. As the economy recovers, we will see opportunities in engineering, cap goods, infrastructure also playing out, because the entire market is polarized towards B2C consumer-driven names with free cash flow, with very less capital investments. But the valuation premiums in that space are at a point where I can't make a case of a high IRR if one invests into some of those names. So the way we see it is that it would make sense to look at cap good engineering, some select utilities, pharma space. So these are broad spaces that we kind of like, apart from banking, where we prefer the large dominant names.
Just before we wind up, what are your thoughts on the corporate tax cut led rally?
So if you look at the current quarterly results, the way they've panned out, which is very much in front of us, in many cases we are seeing top line to be kind of lower than expectation, but margin tailwinds have still played out. And obviously the corporate tax rate benefit has come in as a welcome surprise in the current year, and that is permanent in nature. So essentially that tailwind is very much live, because that tailwind is very much permanent. It is driving my operating cash flows and free cash flows. And the missing element of the last cycle, which is price-led growth because of high inflation, in my view can get compensated with this tax cut, which can actually be a replacement to the price-led growth that one saw earlier, and this is sustainable in nature. So in our view, this is definitely a very strong tailwind, because markets are actually slave to earnings and return on equity. This corporate tax rate cut to a large extent has boosted both the outlook on corporate profitability and the outlook on return on equity. So definitely the market rally that we saw in the recent past post this corporate tax rate cut is not unfounded, and it's a well called for rally.
Thanks, Kashyap, so much for that.